Welcome to Academic Gain Tutorials. In this video, we will look into the differences between short-term and long-term capital gain. The short-term capital gain refers to the profit earned by an individual on account of the transfer of the short-term capital asset. On the other extreme, when a long-term capital asset is transferred by an individual, the profit earned is called long-term capital gain. The primary difference between short-term and long-term capital gain lies in the period for which the capital asset or investment is held by an individual. So, let's look into the basic differences between short-term and long-term capital gain in a tabular form. Difference number 1. Short-term capital gain is one in which profit earned from the sale of the capital asset is owned by the assessee for a period less than 36 months. Conversely, when the asset transferred is held by the assessee for more than 36 months, the gain arising out of such transfer is termed as long-term capital gain. Number 2. On the transfer of immovable property by the assessee, if the period of holding is less than 24 months, then the gain arising out of such transfer is known as short-term capital gain, while if the same is held for a period exceeding 24 months, the gain is termed as long-term capital gain. Number 3. In the case of financial assets, the period of holding is reduced to 12 months, so if the asset is held for less than 12 months, then the gain from the transfer of such asset will be short-term capital gain. On the contrary, if the securities like shares or zero-coupon bonds are held for more than a year, the gain effected from the transfer will be long-term capital gain. And, difference number 4. Short-term capital gain is taxable as per normal income tax slab rates. In contrast, the long-term capital gain is chargeable to tax as 20%. To sum up, the capital gain is one of the heads of income under the Income Tax Act. Both short-term and long-term capital gains are chargeable to tax, but exemptions are also defined in the Income Tax Act. The basic difference between these two lies in the length of time for which the assessee owns the asset. So, these are the differences between short-term and long-term capital gain. If this lecture was helpful, give it a thumbs up and subscribe to the channel. Thank you.